Welcome traders to another Tickmill trading update with me, Patrick Munley. Want to update the S&P 500 view using the E-mini futures contract and put together a idea of some action areas for the trading week ahead and some price targets we can realistically have in our sights. So in terms of where we are from the market dynamic, obviously last week S&P 500 was under pressure amid escalating Middle East tensions, soaring oil prices, and higher bond yields, which obviously dampened risk sentiment. Growth concerns intensified as crude oil surged, shifting focus from a soft landing to inflation risks and potentially slower growth. Despite a softer payrolls report on Friday, markets remained fixated on yields and oil and the geopolitical risk landscape, limiting relief for equities. Positioning reflected de-risking rather than panic, with rallies struggling to sustain momentum. Heading into this week, in terms of key risk events, Wednesday's CPI report could either ease or exacerbate those stagflation fears, while Friday brings data releases with respect to core PCE, Q4 GDP estimates, JOLTS, and University of Michigan sentiment. Also want to keep an eye on earnings. We're going to get Oracle on Tuesday and Adobe on Thursday, may signal enterprise demand trends, but essentially will hold less direct impact on the markets, as the main focus this week will remain the Iran-related headlines, and certainly want to keep abreast of those. In terms of market volatility, remains elevated. VIX sitting just below 30, and intraday swings of 1.5 to 2% should be expected. Straddle for the week goes out at 2.84%. Marking a yearly high. While realized volatility is expected to decline into mid-March, sudden moves could disrupt this trend. Liquidity inflows from vol control funds may decrease, and a potential dead cat bounce could limit exposure increases. The sharply backwardated VIX curve highlights fears of further Iran escalation. Options positioning reflects strong downside bias at the moment, signaling widespread preparation for further decline within the options market. So let's take a look at the technical picture now, and starting on the weekly time frame here, you can see that we're trading meaningfully below now the 20 period and the 5 period volume weighted average price. Obviously, we gapped down overnight. We are attempting to fill the gap at the moment, but they converge now in and around 68.50. So whilst we're below there, focus remains on the downside. I'll be keeping a close eye on any test of the weekly anchored weighted volume average price going back to last April, so the post-Liberation Day swing lows. That coincides with a high volume node here on the weekly profile. So 64.70, 64.50. If we start to make meaningful moves to the downside, I'll be paying attention in that area as a potential zone for at least some profit taking and a pause and a potential counter trend move to trade to the upside. In terms of the daily profile, we are again sitting well below the 5 period volume weighted average price, coming in just above 6,800, which coincides with the gamma flip zone that we'll look at in a second on the intraday time frame. And again, in terms of downside targets now, we have projected ascending trend channel support coinciding with the weekly expected move to the downside. So 65.50, 65.40, want to be paying close attention on any tests into that area as a potential for a, like I say, a profit-taking pause there and a bounce or counter trend move to play for. And certainly we'd be thinking about the gap fill as the initial target on the upside into that, back into 67.50s there. And like I say, if we lose that support, the next area of interest is going to be this anchored volume weighted average price from the post-Liberation Day lows. 64.60, 64.50 will be the next area of interest. Downside targets. In terms of the intraday setup, let's pull that chart up and see where we are. So the play really, again, from the gap lower has been for a corrected bounce to ensue. Key test now is going to be back into the prior cycle lows here, that double bottom that we had in the 67.20 zone. And I'll be paying close attention to how price responds there. That could be an area where we see higher time frame sellers step back in to target the weekly expected move to the downside back into that 65.50, 65.40. To get really constructive on the upside, we'd really need to see a close back through 67.60, where the VWAP closed out last week. If we can get acceptance above there or a daily close above there, then I get more constructive. Looking at a test of the gamma flip area, 6,800, where that's the daily volume weighted average price comes in. And then if we can get acceptance above there, then we'll be targeting the expected move to the upside back into those 69.40s if we can get, like I say, daily close above 6,800 and get some acceptance developing there. But for now, the focus today in terms of intraday, I'll be watching for any test back into the converged VWAP and mid here, 66.40. The volume point of control has now shifted higher into the upper end of the distribution. So we are looking to test into the bull bear zone. That'll be the first key test this week to see if, like I say, higher time frame sellers step in to take us back down to target the weekly expected move to the downside. As always, traders, plan the trade, trade the plan. Most importantly, manage your risk. Until next time, thanks very much.